Welcome back to The Explainer. So tax season is rolling around again, and look, we all know it can be a little stressful, right? Especially if you're investing in partnerships, S-corps, or certain trusts, because your personal tax return is about to get a highly specific addition. I'm talking about the Schedule K-1. Today, we're cutting through all that complexity to show you exactly how this form works, why you actually need it, and how to use it to optimize your filing. Okay, let's dive into this. Picture this. You open your mail, and nestled in there is a Schedule K-1. If you're only used to getting a standard W-2, this giant grid of numbers might look like it's written in a totally different language. I get it. But really, it's just a direct strategic reflection of your business ownership or your investments. And honestly, knowing how to read it is absolutely essential for getting your taxes done right. Here's our quick roadmap for today. We'll start with the Schedule K-1 mystery, then understanding pass-through entities, followed by who receives the K-1. After that, what is on the form, and finally, common mistakes to avoid. Let's get to it. Section 1. The Schedule K-1 mystery. Let's uncover what this mysterious piece of paper actually does. So if you're an employee, you know the W-2. If you're a freelancer, you're definitely familiar with the 1099. But the Schedule K-1? It operates in a completely different lane. It specifically reports the income, losses, and deductions from businesses that you own a stake in. Think of it as a bridge. It bridges that critical gap between a business's internal ledger and your own personal 1040 tax return. Moving on to Section 2, Understanding Pass-Through Entities. Let's examine how the K-1 actually functions under the hood. So, the crucial point is understanding this concept of pass-through taxation. You see, a traditional corporation pays its own taxes. Simple enough. But a pass-through entity operates entirely differently. The business itself pays literally zero income tax. No, really. Instead, the profits, or the losses, pass right through the business and land directly on the personal tax returns of the owners. Now, you might be wondering what kind of entities actually do this. Well, we're primarily talking about three main categories here: partnerships, S-corporations, and certain trusts or estates. Basically, these entities calculate the year's financial activity, they slice up the pie among the owners, and then they document your specific slice using, you guessed it, a Schedule K-1. Which brings us to Section 3, who receives a K-1. Let's find out if you should be expecting one in your mailbox. You are legally required to use the K-1 on your personal tax return if you hold a specific role in these pass-through entities. That means being a partner in a partnership, a shareholder in an S-corp, a beneficiary of a trust or estate, or a member of certain LLCs that are taxed as partnerships. If you wear literally any of these hats, the entity is legally required to send you this form. But guys, here is the plot twist. Even if you didn't receive a single dime in cash distributions this year, you might still owe taxes. I know, no way, right? Well, welcome to the joy of phantom income. It just proves the IRS doesn't actually need you to hold the money in your hand to tax you on it. If your business retains its profits to, say, buy new equipment next year, your paper share of that profit still passes through to you, and yes, it is fully taxable. Okay, Section 4, what is on the form? Let's take a look at the anatomy of the K-1 so it's a little less intimidating. And this brilliantly illustrates how the K-1 neatly splits your financial activity into two main buckets. First up, income types. This categorizes exactly how your money was made or lost, whether that's ordinary business income, interest and dividends, capital gains, or rental income. The second bucket is modifiers. This includes your share of tax credits, deductions, and other items that will ultimately reshape your final tax bill. Now, what's really interesting about this slide is the action required on your part. The K-1 is definitely not a form you just attach to the back of your return and forget about. Think of it like an instruction manual. The data on the K-1 dictates exactly where you must report specific numbers across the different sections of your own 1040. All right, our final stop, Section 5, Common Mistakes to Avoid. Let's make sure you're empowered to file perfectly. Let's move to and see how this builds into a foolproof filing strategy to keep you out of trouble. Step 1, wait. K-1s often arrive well into March or April, so do not file your taxes prematurely. Step 2, do not ignore the form just because you didn't get a cash payout. Remember that phantom income? You still have to report it. Step 3, double check that your ownership percentages and reported amounts are strictly correct. And Step 4, keep an eye out for amended K-1s. If the business changes its math, you might have to amend your personal return too. Ultimately, the goal here is total peace of mind. Accurate reporting of your K-1 data is absolutely crucial. It's what keeps you strictly compliant and helps you avoid costly audits or unnecessary friction with the IRS down the line. Nobody wants that. Now, if you're juggling multiple K-1s from various syndications, private equity, or different business ventures, the complexity can scale up really fast. It's kind of like a giant puzzle. Consider handing this off to a qualified tax professional. It isn't just about saving your own time. It's about optimizing your deductions and making sure your complex portfolio stays entirely above board. Which leaves us with one final question. Are you ready to tackle your pass-through income, or is it time to call a tax pro? You now have a complete map of the K-1, from pass-through mechanics all the way to avoiding the trap of phantom income. So evaluate your portfolio, make your move, and conquer this tax season. Thanks so much for tuning in, and I'll see you in the next explainer.